Hello everyone, a very warm welcome to those that have joined the webinar already. We are expecting quite a few more attendees from several countries today, so while we wait a little longer for those others to join, I'll just run through some housekeeping before we kick things off. So to start with, you'll notice that your lines are muted and your cameras are turned off. Ours are going to be turned off as well during the presentation, just to minimize any technical disruptions, but also to allow you as the audience to focus on the presentation slides. And on your screen, you'll also have a control panel, and you can submit any questions you have in there. We'll try and get through as many of them in the Q&A section at the end. You should also see a resources tab on that control panel, and we'll be posting some useful links to other market and macro research there as well. So do keep an eye on that. As you can see from the next slide, our speakers today include myself. I'm George, the macro and FX strategist based in the UK. And then we have Boris in the middle, our macro and FX strategist from Austria. And then Joe Menimbo, our macro and FX specialist from the US at the end there. And the agenda for today is pretty straightforward. I'll shortly hand over to Boris for an overview of the global economic outlook. He'll be highlighting the most important key themes dominating the macro space and what's influencing financial markets. And Boris will then pass back to me for a UK currency overview, forecast scenarios as well, before I hand over to Joe for his angle on North America, and then we'll finish up with Q&A, as I say. Okay, so I think we've got just over 60 participants on the line at the moment, and we know we've got leaders from various sectors across manufacturing, business services, and financial services, and we want to better understand what macroeconomic and broader business issues are concerning our customers the most, and therefore we like to gather this information via a live audience poll to start with, but this also gives you the opportunity to hear directly from your peers and compare your views as well. So before we move on to the main presentation, you should see a poll pop up on your screen now, asking you the following question. So thinking about the next 6 months, what issue or issues concern you the most today? And you can select one or multiple answers here. And whilst we await your input, I'll just read out some of the options. So cash flow and credit conditions at the top, high interest rates and inflation, geopolitical trade risks, banking and financial market risks, supply chain diversification, transformation, digital transformation, automation, or other at the end there. So just wait a few more seconds. And I think it's about enough time. So I think we'll end the poll there. Let's see what the answers are. Okay, great. Thank you for those responses. The results are in, and we can see that most of you, 60% of you, selected high interest rates and inflation, and the next one was 43% cash flow and credit conditions. And that falls in line with other business surveys currently highlighting this issue. So hopefully today's presentation goes towards ensuring currency risk and international cash flow doesn't aggravate this financial risk any further over the coming months. And whilst not the topic of today's presentation, we also have recently published a research report that speaks to the issue of digital transformation and automation, and that's available to download via a link that my colleague has already put in the resources tab. So please do go ahead and download that, the B2B report that you'll see there for more insights. Now, if we move on to our own key insights for this particular report, before I pass over to Boris, I just wanted to call out some of the key insights from our research, just to cut through the noise and distinguish the important takeaways. So firstly, last month in June, the dollar did raise over 60% of the gains that it made in May. And that's because the Fed took its first pause in this rate hiking cycle. But both the Bank of England and the European Central Bank raised interest rates again because inflation proves to be a bit stickier across Europe. And as a result of those rate hikes, particularly the UK jumbo rate hike that we saw, the pound rose to 14-month highs against the US dollar and to 10-month highs against the euro, because markets are also betting that the UK interest rate is going to climb even higher than 6% this year. So the question is, are we going to see a continuation or a reversal of these recent currency trends? Are policymakers going to continue raising rates and make recession more likely, or are they going to pause rate hikes at the risk of causing inflation to potentially become more entrenched? Obviously, the future path of monetary policy is going to depend on the evolution of the economic data. So with that, here is the risk events calendar that we produced for July, pointing out some of the key data points and events to watch out for. And you'll have access to this via our Global FX Outlook report that's associated with this webinar, and that can be found on the blog section on our website. And the link to that is also going to be posted in the resources tab on your control panel as well. So do look out for the updated version of this July report. Some of the key events to call out from here include the publication of labour market reports. That's because labour markets do remain historically tight in many countries, and that's making it harder for central banks to control inflation, partly due to strong wage growth that we're seeing. The US jobs report is actually due on Friday, so a key event to watch tomorrow. Inflation data from the US comes out next week, and from the UK the week after. And then, of course, we've got a whole host of interest rate decisions due out this month, starting with the Bank of Canada next week, the US Federal Reserve on July 26th, the European Central Bank on the 27th. And the most likely outcome of all these policy decisions is another rate hike, according to both market pricing and by the hawkish remarks from central bank officials recently. And we do agree with these expectations as well for this month anyway. Beyond this month, we're not as aligned to this whole sticky inflation and more rate hike narrative. However, it's going to be hugely dependent on the data, of course. So with that, I'll hand the reins over now to Boris. He's going to unpick the most important macro themes to be aware of and explain this interesting polarization of equities and bonds that we're seeing at the moment and the impact that's had on currencies. So over to you, Boris.
Well, thank you very much, George, for the brilliant introduction and quite a nice segue with the poll into my part of the presentation. Of course, a warm welcome to everyone listening to this webinar as well from my side. I'm quite happy to be able to join our FX and macro strategies team today and to really shed some light into the recent macroeconomic development that has shaped financial markets for quite some months now, and to also try to give a bit of a forward guidance going into the month of July, just in terms of what we and what our markets looking out for. George already did quite a good job laying out the key events that investors will focus their attention on. So my part is more centered around bringing these individual data points that we have seen into not only broader themes that we can follow, but also narratives to just better understand market behavior. So we will be looking at 3 individual separate themes today: inflation, monetary policy tied with the fixed income space, and then the macro side of things, before we then in the end dive into our focus theme for July and our focus event. So starting with this first page here, I would like to talk about inflation a bit more. For some of you who have already joined our previous couple of webinars, you would know that this theme has been a constant topic throughout this webinar series, just given the weight inflation has played for not only central banks, but also households, companies, and financial markets. It is still the case today that inflation in general and all these individual inflation data points, as George mentioned, remain relevant for us and relevant for markets. However, it is important to note at this stage that the inflation dynamics that has governed markets for the last couple of months and years actually has started to change, and that the debate surrounding these price developments is more than just trying to ask a binary question of is inflation going up or down in a particular country. We know that inflation in the most part of the developed world has already peaked sometimes between Q3 last year and Q1 this year. And given our leading indicators, which George already alluded to a bit, we do expect consumer prices to continue falling, even more so than the broader consensus. However, the debate, as I said, has already shifted from not only gauging where inflation will peak at the end, but to how fast inflation will return to the 2% target the central banks give themselves. And in this chart, I think we can see quite clearly that these 2 points of peak versus the longer term inflation expectation just have to be treated differently. So while the blue line in our chart here, which depicts the share of the countries with extremely high inflation, meaning inflation above 8%, has fallen quite significantly in recent months. the green line showing the countries with inflation just above 4% has really experienced a much lesser fall. And the share of countries with inflation of around 2%, meaning the central banks that are currently hitting their inflation target, has really not moved that much in recent months, shown in gray at the bottom. And this, in our opinion, is really crucial, because it is true that headline and goods inflation as well are falling, just based on the normalization of the supply side factors and the normalization of supply chains. But the demand-driven stickiness of, let's say, core inflation and the services inflation has really made it difficult for central banks to proclaim an early victory over their fight against inflation. And this is something we have seen in the last couple of weeks. Policymakers have really been vocal about their commitment to bring down inflation back to target in recent weeks, and which has obviously pushed back these expectations of any premature easing of policy in the UK, in Europe, and the US for the year 2023. It is important at this stage for us to note that, again, we do think that inflation in the US and in Europe will start falling a bit more sharply than currently priced in the medium term. And this is a thesis we lay out in our daily market updates and in other publications. But because of these extreme data dependence of central banks and the importance of just the next CPI or inflation print or just the next jobs report, it could be well the case that an upside surprise in one of these individual data points, which normally shouldn't matter that much in a broader context, one single data surprise could well mean that central banks have to hike more in the medium term, surprising the market expectations, which in the end would increase the likelihood of a recession in these major economies. And I think markets have tended to agree with this view, as we can see on the next slide here, because the last couple of months have really been clearly shaped by, again, inflation falling, at least headline inflation, while policymakers continued to shift their focus from headline inflation to core inflation. And this subtle shift from looking at headline, which is falling, to this stagnant core inflation rates has really given central banks the ability to remain hawkish and to prop up the interest rates at the front end of the yield curve, even against the backdrop of some of the weaker economic data that we have seen from China or, for example, from Europe. And this is exactly what we can see in this chart here, which on a simple level just shows us the aggregate average yield curve for these three countries, meaning the US, UK, and for Germany. And the repricing of rates at the short end that we can see here, let's say on the 1, 2, or 3 year basis here on the government bond yields, has really been quite significant. If we just focus our attention on the 1 year government bond yield, it has risen from around 4.1% to 4.7% just in a time span of 4 months. The same, as we can see also in this chart, cannot really be said about the long end of the yield curve, which has pretty much remained constant, not only throughout Q2, but also for the past 7 to 8 months. And in our opinion, this means that markets are clearly indicating that, yes, all these hawkish central bank speeches and sticky core inflation are enough to prop up the front end of the yield curve. But longer term investors already see that these disinflationary processes have already started, and that the probability of a recession has slightly increased in recent months, meaning it has pushed up the demand for these longer dated safe havens and pushing in the process down the yield of it. And this is precisely why in this particular segment, we ask, what does higher for longer mean for markets specifically? We know that markets interpret it as expecting no rate cuts in 2023, meaning they have pushed out all rate cutting expectations for the BOE, the ECB, and the Fed well into 2024, which is the case for most G10 central banks. And because of the divergence between the yields on the short end, which have risen, and the yields on the long end, which has pretty much remained constant over the last couple of months, the two-stance yield curve, which basically displays the difference between what investors get paid to hold longer dated bonds versus shorter dated bonds, has fallen to the most negative since the 1980s and 1990s for these three countries. And this inversion has historically been one of the best indicators for an upcoming recession. And this exactly brings me to my third global market theme, namely the impact of monetary policy, and specifically the tightening of monetary policy on the real economy. As with our inflation slide in the beginning, the importance for me here really lies in understanding the overall complexity of the topic and not just asking again these binary questions of, is country XYZ in recession? It is a fact, and it is true, that some economies, in particular the US, have held up much better than economists had expected. Hard data points like retail sales, industrial production, consumer spending, jobs growth, all of these have been much better than expected. But other parts of the economy, like the property market, for example, or even something that I've displayed here, the manufacturing sector, have been in recession for multiple months now. And this is why, at least sometimes, it is really important to look at individual sectors instead of the whole economy in general. Companies, for example, in the manufacturing sector are really interested in their particular field and how producer and factory prices are developing instead of focusing on core inflation rates like central banks. And because sectors have these different sensitivities to the global business cycle and also are impacted differently by monetary policy, of course, we get this divergence that has played out in recent weeks between the weak industrial sector on a global basis and the strength of the services sector, the consumer and these labor markets. And in the end, it is our opinion that these will have to converge at some point or the other in the business cycle. And there are valid arguments for both the services sector to fall to the level to the manufacturing sector and for manufacturing to be pushed up again by the resilience of the services sector. However, with most of the shock of the higher rates environment estimated to just start hitting the real economy in the second half of this year and partially in the first half of the next year, it is really difficult for us to imagine the manufacturing recession not spreading to the wider economic activity. And so, in my opinion, the recession debate that we are having is really the key to the inflation and the monetary policy question that we have asked in the beginning, in the next slide. Because as a reminder to these two questions that we have posed, we ask, where will inflation settle, first and foremost, and then what does higher for longer even mean for markets? And for us, both of these questions are really tied to the general health of the economy, because we have showed that the repricing of the interest rates and the yields in the front end and pricing out all these rate cuts for these three central banks have really been a function of just strong economic data and stickier core inflation rates. In Europe, granted, it is a bit different because economic data is really starting to come in weaker than economists had expected. But high core inflation rates, again, have been able to at least somehow justify higher yields for investors. But core inflation rates can only be elevated for so long with an economy going into recession. And historically, we know that recession in combination with high policy rates tend to bring down inflation. And with policy rates this elevated for all the countries that we are looking at, and the New York Fed putting the recession probability in the next 12 months to around 70%, which is the highest probability in the last 40 years, the pressure on central banks to turn less hawkish will really start to be visible sooner than later. Probably not at the upcoming July meeting, as George mentioned, because these hawkish rhetorics and the commitment to hike in July has already been done. So central banks have kind of already pre-committed to hiking in July. But in our opinion, the next rate decisions in September or even then in November will be more open ones, with the bias clearly shifting from not anymore just hiking rates without looking at the data, but really starting to look at the data and maybe pausing tightening cycles. And while it would be the first time that the US doesn't fall into a recession with the yield curve that inverted and recession probabilities that elevated, we have to say that it is still a possibility, right? It is important to note that nothing is still set in stone. Because of all these pandemic-related effects, the huge stimulus we have gotten in the years 2020 and 2021, consumers have really been able to weather the inflationary storm better than anyone would have expected. So if we get a cyclical uptick of the manufacturing sector, which is currently in recession, as I've talked about, before the services sector turns negative, we could well, in case, get a soft landing and a no recession scenario. But even then, as I highlighted, this would only mean that central banks would have to hike rates higher and let them be there for longer because of sticky inflation, which would, in the end, in the medium term, once again increase the recession risks down the road. The final topic I would like to address in my last slide is, again, a divergence. It's a divergence between different asset classes in recent months, which will be, I think, a good segue into our FX outlooks. So in this chart, we can see proxy indicators for the US financial market. We can see a proxy indicator for the US stock market, the US bond market, and the US currency. And the things I'm about to say should pretty much hold true for any G10 currency and G10 market. So starting from 2022, we can see that cross-asset development, meaning the development in financial markets more broadly, has really been split into two distinctive phases since the beginning of last year. The double sell-off in risk assets and inflation-sensitive assets like bonds, from which the US dollar greatly appreciated, this theme or this phase kind of peaked around October when GBP USD was hitting multi-year lows and Euro USD was at a 20-year low. And since then, we had the second phase where we got a rebound in all of these factors, meaning stocks rebounded. For example, the US stock index NASDAQ is up 40% year to date, and Euro USD and the pound also greatly benefited from this reshifting of risk. For us, again, it's important to mention that even though we can distinctly say we have two separate phases going during the last 2 years, it is important to say that these three asset classes have been pricing in a bit of different scenarios in recent months. For example, why did the US dollar continue to sell off while bonds remained pretty much stagnant over the last couple of months? And why did stocks rally even though the expectation of Fed rate cuts for this year have all but vanished? So there is a clear disconnect between what equities is pricing in, meaning a much more positive outlook on the economy for the next 6 to 12 months, and what the fixed income space has been pricing in, meaning higher rates, or at least on the longer end, constant rates, which would normally not support such a strong risk rally. So just to summarize my kind of key points here before handing over to George and my colleagues, we can see that market participation or market participants in this case have really shifted their focus from headline to core inflation. And this allowed policymakers to just continue hiking while ignoring the weakening of these leading indicators. And this has led, as I showed, to yields rising at the front end, leading the yield curve to invert and increasing the recession probability in the medium term. However, what we also have to say is that stocks and risk-sensitive currencies have remained quite resilient to this higher for longer narrative from the Fed, Bank of England, and ECB, primarily because of the tech and AI-driven boom propping up global sentiment in the last couple of months. And because one major point to mention here is that while rate cuts have been postponed, meaning from this to the next year, markets didn't really completely cancel the prospects of rate cuts down the road, which is also an important factor of the risk-sensitive rally. We think, again, like the divergence between the manufacturing and the services sector that I've mentioned, so too must the split between these rallying risk assets like stocks and stagnant fixed income assets have to converge at some point. And these divergences between services and manufacturing and the fixed income space and the equity space really make July quite an interesting month for us to follow, especially given the upcoming rate decisions from all the major central banks. So with this in mind, I think I can hand over to George and Joe, who will start talking more about what has been driving currency market in recent months and weeks.
Yeah, brilliant. Thanks for that, Boris. Plenty of valuable insights there to digest. I think just to emphasize, obviously, central banks do remain data dependent, of course, but clearly at the moment, there's that bias towards resuming rate hikes. And it does appear officials are increasingly willing to tolerate a recession for the sake of price stability, it seems. And yet, as you mentioned, equity markets continue to rally based on better than expected economic growth, whilst we're seeing bond markets still aggressively sending those recession warnings via the volume of inverted yield curves there. And so we've got this interesting divergence, as you said, going on in financial markets. And as Boris mentioned, our job now is to look at how currency markets have evolved over the past few months and what might unfold in the future. And we'll be doing that using scenario-based analysis. And I'm going to be looking at the pound in particular here before passing over to Joe for a North American perspective. So firstly, let's have a look at some of the recent volatility that we've witnessed in sterling denominated currency pairs. This heat map table on the left provides the 30-day and the year-to-date highs and lows, the size of the trading ranges during these timeframes, and the position of the currency pairs within these ranges at the moment. And as you can see, some huge ranges year-to-date already of the pound against the likes of the South African rand, the Japanese yen, Chinese renminbi, and the NOK, the top four there. And I'd like to call out the Japanese yen and Chinese renminbi here, because these major currencies have stood out as underperformers because their central banks are either keeping interest rates at record lows or reducing them. And that goes against the grain of other major central banks hiking since late 2021, and therefore reduces the yield appeal of the yen and renminbi. Hence, you can see on the far right of that table in the teal boxes that the pound is well in the top 10% of both its 30-day and year-to-date ranges against the yen and renminbi. And sterling yen is actually around 16% higher so far in 2023 and hit its highest level since 2015 recently. And against the US dollar, the pound had another strong month last month, swinging in over 4% range, but it ended June about 2% higher and traded above 128 at its highest level in 14 months. And if we look at the year-to-date stats, that currency pair has swung nearly 9% and is up around 5% since the start of this year. And that makes 2023 the strongest start to a year for the pound versus the dollar since 2017. Now, one of the main reasons for the strength of sterling is this surge in UK interest rate expectations to beyond 6% for this year. And in fact, today we've seen another hawkish shift in markets, fully pricing the Bank of England's policy rate reaching 6.5% by February 2024. And as Boris said, this is due to inflation proving more stubborn, particularly in the UK, and particularly so in the services sector. So with rate expectations rising, as we're seeing, UK gilt yields have marched higher, and more so on the short end, as Boris mentioned. But this does attract investment capital inflows to UK assets, thus strengthening the pound's value, as we've seen. And the chart on the bottom right of this slide also highlights this notion through the correlation of the sterling dollar exchange rate with the difference between the UK-US 2-year government bond yields. And that differential, that difference is at its highest since 2014, primarily due to UK yields climbing so sharply in line with rate expectations. So it's no wonder investors are becoming more attractive to the pound over other currencies right now. But we do think for the pound to maintain this advantage in this high interest rate environment, UK economic growth has to remain resilient as well. Alternatively, a high interest rate but low growth environment in the UK would probably be unsupported for the pound's valuation, and we need to be wary of that going into the second half of this year. Ultimately, interest rate hikes are usually positive for a currency, but that's as long as the economy is able to withstand those higher rates. So the question is, at what point will these higher rates start to have more of a negative impact on growth in the UK? The fact that things didn't get as bad as feared doesn't automatically lead us to be overly optimistic, because as Boris discussed, a higher for longer interest rate environment might only increase the risk of recession. However, as it stands, because of the delay to a UK recession that we've seen so far and that yield appeal, the pound is the best performing major currency so far this year. It's stronger than 80% of 57 currencies globally, and on average, it's over 7% stronger versus these currencies, which is great news for UK importers selling pounds and needing to buy foreign currency. Not so good news for UK exporters selling foreign currency and buying pounds, though. But here on this slide, we're looking at our value indicator analysis, whereby we can see where the pound is currently positioned relative to its long-term averages against other major currencies. And this allows us to identify from a bit of a wider lens any FX purchasing opportunities, but also any risks as well. So for example, if you look at sterling versus the Japanese yen and Chinese renminbi, again, over 10% above its 1-year averages. And sterling yen is in particular is a whopping 22.5% higher than its 5-year average rate. And this is because, as I mentioned before, the Bank of Japan continues to keep interest rates at record lows, whereas the Bank of England has raised rates 13 times in a row now and standing at 5%, its highest level since 2008. However, in terms of the Bank of Japan, we are on the lookout for some possible FX intervention again soon, and that's to try and tame the yen's depreciation of late. And I think Joe's going to cover this in a bit more detail shortly in his section, because this kind of intervention often tends to relate more so to the position of the US dollar Japanese yen exchange rate. But if we look further down the list to sterling euro, it's still over 2% above its year-to-date average. And if you look to the right of the table, it's 1.6% above its 5-year average of 114.60. Now, we don't see as much volatility in this currency pair, relatively speaking, but due to the growth and interest rate differentials favouring the pound right now, the current positioning does make some sense and could be seen as a decent opportunity for hedging future euro purchases, especially when we compare it to the value of its value to its current long-term averages anyway. And against the dollar, I'm sure there are many on the call who remember the days of the 150s before Brexit, but even the days of 130s post-Brexit. You know, the fact that sterling and dollar has been well below that 130 mark and continues to be below 130 for the longest ever period recorded. You know, it's likely been a major challenge for many businesses out there, especially for those without any currency hedging in place. But if we look at where the exchange rate is currently compared to its year-to-date, its 1-year and 2-year averages, the pound is actually favourably positioned. I mean, granted, it's still 1.3% below its 5-year average of 128.70, but none of these average rates now are actually above 130. And we've seen a pullback from the recent highs after climbing into a so-called overbought territory, according to some technical indicators we're watching, and I've highlighted that on the other chart on the right-hand side of this slide here. You know, so in our opinion, the pound's current position against the dollar does make sense, but it should also be seen as perhaps quite an attractive one when we compare to long-term average rates in general, and therefore presents a decent hedging opportunity perhaps for UK importers, but also for any US exporters needing to sell pounds and buy dollars. But of course, we do appreciate organisations will have a certain opinion of exchange rates, different views of hedging opportunities as well. And that's why we provide as much data-driven insight like this as possible to support those strategic conversations with your corporate hedging managers. Because when it comes to currency planning, the aim is to help businesses identify and assess the drivers of these risks and opportunities, but also to understand their own risk appetite and tolerance and their own business objectives to then help develop and implement that currency strategy. So with that, I'll move on to the FX forecast scenarios. And firstly, to reiterate our position at Convera, we believe taking this scenario-based approach is more appropriate as opposed to outright trying to predict where the exchange rate is going to go or end up over a certain time frame. And that's purely due to the inherent inaccuracy of trying to forecast this. So instead, evaluating various scenarios that may occur in the future and understanding the possible exchange rate scenarios should help businesses identify any high-risk situations to try and to avoid or minimize potential losses, but also to identify any opportunities that you can prepare to act upon as well. So just to explain the chart, the left-hand side of the chart shows the historical exchange rate of sterling against the US dollar in this case, and the right shows the different paths the exchange rate could take. And in partnership with Oxford Economics, a base case scenario and a higher low scenario are generated via an economic model using many variables such as interest rate growth and inflation differentials. And from that baseline, we calculate one standard deviation above and below to provide a more central scenario, and that's the grey shaded area in the middle of the chart there. And via our calculations, that will cover 68.2% of the outcomes. So in layman's terms, there's a near 70% probability the exchange rate is going to fall within this range. And this range has actually been revised slightly higher from last month's forecasts, and that's based on the developments both in the UK and in the US in terms of economic and monetary outlooks. And we discussed those earlier in the webinar. But the top end of the central range by the end of this year is 131, and the bottom is 120. And this will be heavily dependent on the income and economic data and policy decisions, of course. If the UK economy continues to remain resilient, supported by the excess savings households have at present and the acceleration in nominal wage growth that we're seeing, keeping consumer demand strong, then inflation may take longer to come down, yes. But This puts pressure on the Bank of England to keep interest rates high, which is constructive for sterling, as we've seen so far this year, especially if the economy doesn't slip into recession. But of course, this is a big if, especially considering the increasingly negative impact these higher rates are going to have on mortgage holders. And this is a big story that's being reported on in the UK right now, and rightly so. It's one that keeps that downside scenario firmly in view. Perhaps sterling dollar trades back below 120 if we do witness a housing crisis and a deep recession as a result of the lagging effects of tighter monetary policy. It's worth mentioning that the share of UK households owning a property with a mortgage has declined from 40% in the 1990s to less than 30% today. And actually those with a floating rate mortgage have declined significantly. So therefore, that makes for a longer, more drawn out transmission of monetary policy to the real economy. And there are three ways this could eventually affect both the UK housing market and the broader economic output. And firstly, persistently high rates are going to drag that residential investment and real GDP down. Secondly, that rising effective mortgage rate is going to eat into disposable incomes. And thirdly, higher rates may reduce those house prices over the coming years and contribute to a fall in consumption via the wealth effect. So hence that risk of a UK recession is certainly still alive. It just seems to be taking a bit longer to materialize. So of course, this extreme scenario, like this, we have to acknowledge them. It could see sterling upside fade very quickly, sterling dollar fall back into those teens perhaps. But of course, there's that upside scenario of the higher 130s, which is also plausible. If we see that cyclical uptick of the UK manufacturing sector before the services sector turns negative, we could avoid a recession, whilst the Bank of England keeps interest rates high and given the pound or the pound maintaining that yield advantage that it has over the other currencies, particularly the US dollar right now, especially if the Fed starts cutting interest rates earlier than what's currently priced in. And also I mentioned that if volatility in financial markets remains low, this should keep risk appetite alive as well. And the pound is going to benefit from this, given its strong correlation with global equities in a risk-taking environment. But the main takeaway, as ever, is no one really knows what the future holds. Opposing forces are always in motion, and many divergences that we're currently experiencing should soon converge. So it's imperative to consider these range of scenarios to make sure that as a business you're sufficiently positioned to take advantage of moves in exchange rates that are favourable to you, but also sufficiently positioned or protected rather in the event of any adverse moves unfolding. But finally, I'll just move on to sterling euro. As I mentioned at the start, this currency pair tends to trend in a tighter trading range, but the baseline forecast has been revised substantially higher from 114 to 117 over the past couple of months due to interest rate expectations from the Bank of England being a lot more hawkish than that of the ECB. However, the underlying price pressures do remain highly elevated from a historic standpoint in both UK and Eurozone, and that would justify both central banks continuing to raise rates in the short term, providing no extreme real advantage to either the pound or the euro. But as Boris said, we do expect headline and core inflation to fall as energy effects fade and via our array of leading indicators for inflation being sharply lower as well. So the focus might be more on how severe any economic downturn is going to be in either region. So this tug of war between the pound and the euro is probably going to continue unless we see any major divergences in the economic data and monetary policy expectations. But what I will mention is that when we have seen this currency pair break out the trading range, it's often triggered an acceleration in that direction, and hence that's why we have that wide range within a central scenario, 126 to the upside and 108 to the downside by year end. Personally, I don't see either of these playing out anytime soon, but to the upside scenario for the pound, firstly, from a technical perspective, we need that 117.50 to break. That's been the 11-month high resistance level. But also from a fundamental perspective, we'll need to see a continuation of a hawkish Bank of England relative to the European Central Bank, which is why these upcoming central bank meetings are more importantly, the plethora of data beforehand remains critical. And realistically, given our inflation thesis, there is probably more chance of the Bank of England undershooting on rate expectations than overshooting, which may limit any further gains for the pound, or significant gains anyway for the pound. And one final note from me is that we do produce these FX forecast scenarios for hundreds of currency pairs. So do reach out to your account manager if you require any further insight into other currencies. But that's it from me. I'll hand you over to Joe now for his viewpoint across the pond. Cheers, Joe.
Okay, George, thank you so much. And thanks also to Boris. A lot of unpacking going on there, and certainly made terrific sense of both a global backdrop as well as the scene over there in Europe. So now it's my pleasure to present the North America FX landscape. For the first slide, we're going to look at some volatility. Central bank monetary policy that has been supplying the main source of FX volatility. And while the dollar index was little changed over the first 6 months of the year, there has been some notable volatility going on for the greenback. For instance, the dollar this year is trailing behind its rivals from Canada and Mexico, among other currencies. And I do want to call out USD MXN, dollar Mexico, as illustrated here. And this ranks towards the top of the volatility chart on a year-to-date basis. You can see that in the second line there. The range has been 19.5 to 17. So that represents double-digit volatility of nearly 15%. And that's quite elevated compared to some of the other swings in volatility that we've seen. And as the chart shows, the pair, dollar Mexico, is situated near the bottom of the range, whether you're measuring that over the last 30 days or since the start of this year. And it's really about interest rates. In Mexico, Mexico has had to raise interest rates to bring down inflation above 10%. In fact, rates in Mexico are at record highs of 11.25%. And that level, and that's more than double what the Fed is offering at just above 5%. So those interest rate differentials, that has been a strong source of support for the peso. Now, in the situation for dollar Canada, which has spanned a range so far this year, 131. That 131 we saw not too long ago. That was actually a 9-month low for the greenback versus Canada. So 131 to 138. And that has been the range that we've seen so far. Now, Canada is quite an interesting case because Canada was the first among the big central banks to pause and move to the sidelines after raising rates aggressively over the past year. But Canada, they didn't stay there. They hiked again last month. They raised rates by 25 basis points, brought them up to 4.75%. That's the highest level in 22 years. Excuse me, 22 years. So the Canadian dollar, or the loonie as it's affectionately known, has also been supported by Canada's economy, whose resilience is still keeping the door open to another rate hike. We did touch on earlier in some of the key events for this month. We're going to hear from the Bank of Canada next month on the 12th of July, Wednesday of next week. It's considered a close call whether or not Ottawa hikes interest rates again. And we're going to have some key jobs data from Canada, from both Canada and the US tomorrow, but Canada in particular. If we see another strong jobs report, that could be very important for policymakers and maybe even decisive, depending on how the data fare for that meeting next week by the BOC. So in the next slide, I want to cover some of the value indicator perspectives. The value indicator shows how much bang one currency one gets out of a currency. So in this case, the US dollar, and I do want to highlight dollar yen, whose strength has been quite sharp. We continue to see significant strength for the dollar versus the Japanese yen. And the main factor, once again, is a familiar theme that we've been talking about: monetary policy, or simply interest rates. While the Fed and other major central banks have gone to great lengths to raise interest rates to tame inflation, Japan has sat idle. Their key rate is just below zero, and those interest rate differentials have really come at the expense of a weaker yen. And we did see Japanese authorities intervene last September to try and put a floor under the yen. And where we are now, we're not far from where we were then in terms of levels that triggered intervention. So 144 to 145 for dollar yen. That's recently served as a line in the sand for how much yen depreciation Tokyo may tolerate. So we're going to be keeping our eyes on that level. If we continue to see dollar weakness, if we continue to see yen weakness, that would certainly raise the risk of Japanese authorities stepping back into the market, selling US dollars and buying yen to try and steady their currency, because a weak currency, that is certainly inflationary. That is certainly a problem, because that makes the cost of essentials that Japan imports stuff like oil, natural gas, and food more expensive. So that's why that's one of the reasons why Japanese authorities may go to some great lengths to try and steady the yen. Like I said, potential intervention if we see dollar yen rise above the key 145 level. So that's the thing to look out for. Now, in the next slide, I do want to talk about Euro USD or Euro currency future scenarios that could drive some of the volatility going forward. Euro dollar this year has gained about 2%, or at least that was the picture over the first half of the year. We've seen the euro really boosted by expectations that between now and the end of the year, we could potentially see more rate hikes from the ECB than from the Fed. And that's why the euro's gone from 107 at the start of the year up to 109 at the mid-year point. And we have seen the euro climb as high as not quite 111, 110.95. That was the high we saw a few months ago. But like I said, we've since seen the euro come off some of those peaks. And some of the things that have dampened upside for the euro has been concerns about European economic weakness, especially in Germany. Germany, the bloc's biggest economy over there. Germany contracted in both the fourth quarter of last year as well as the opening quarter of this year, and its prospects for Q2 really haven't improved much. So that suggests that this downturn that we've seen from Germany may have legs over the first half of this year. And if that's the case, maybe that could be a scenario that, like I said, maybe puts a lid on euro upside, and maybe we stick around the levels where we are right now, right around, below 110 against the US dollar. Now, on the other hand, what could boost the euro? Well, we'll keep our eyes out on the global scene. For example, how does China's economy continue to fare going forward? Do we see the Chinese recovery start to gain traction? If it does, that would tend to suggest a better outlook for global growth. And under that scenario, that would tend to sap demand for some of the safer bets like the US dollar. So if we get a situation like that, that could be a situation that lifts euro dollar towards maybe above 110 by the end of the year. Then again, we've touched on some of these already. Some of the downside scenarios for the euro against the greenback potentially move towards 105. Well, if we see the European recession, if we see not so much the European recession, it's mainly Germany that's experiencing the downturn. But if that were to broaden, if recession risks in Europe were to intensify, that would certainly be a negative development for the euro, because what that could do is potentially bring about, maybe that could hasten the end of the ECB's tightening cycle. So we'll have to keep our eyes on that. And then we've also touched on that there's a Fed meeting this month. Later on in July, the Fed is expected to raise interest rates after pausing in June. So we'll have to see if indeed the Fed raises rates by 25 basis points, and we'll have to see what they suggest about the road ahead. Does the Fed raise rates in July and keep the door open to another move, say in September? Well, that would certainly be positive for the greenback versus the euro. And again, under that scenario, that could be a situation that nudges euro dollar towards the direction of 105. Now let's turn to dollar Canada future scenarios. For dollar Canada, we saw dollar Canada kick off the year 135 was the level. This year the range has been 131 to 138, and the central scenario calls for a level of around maybe 137 by the end of the year. And that's on the view that if we continue to see prospects for global growth moderate, that might weigh on some of the commodity-backed currencies like the Canadian dollar. That's why some people are forecasting, as well we are forecasting a bounce back in the dollar versus Canada around the 137 level by the end of the year. Could dollar Canada really gain some steam and take aim at 140? Well, for that to happen, you need to see Canada's economy start to lose some steam. It's certainly proven resilient this year. But if higher interest rates in Canada, if they start to spur a bigger than expected retreat in consumer and business spending, well, that might lead the Bank of Canada not only to halt rate hikes, maybe that could pull forward the time frame for Ottawa to cut interest rates. And under that scenario, that could be something that could lift dollar Canada towards 140. But as we've seen this year, the theme has been Canadian dollar outperformance against the greenback. And we could see a move down towards 130 over the coming months. We haven't been there quite yet this year, but we could see a move down towards 130 if Canada's economy, again, continues to display this remarkable resilience. And the tight labor market, if we continue to see that, that would tend to set a high bar or a higher bar for Ottawa to change course and cut interest rates. And we'll have to see what the outlook holds for the Fed. Does the Fed raise rates one more time this year? Two more times? If it's towards the lower end of expectations, well, that could be something that could sap demand for the greenback as well, and maybe give some momentum to the Canadian dollar versus its U.S. counterpart. So that's the scene here from North America. Now let's do some Q&A.
Yeah, thanks a lot, Joe. Some excellent insight there from the North American perspective, as usual, especially thinking about the different scenarios for euro dollar and what could play out, because as we know, that's the most heavily traded currency pair in the world. So, any major swings that we see there could have knock-on effects to other currency pairings as well, such as sterling euro, for example. So thank you to everyone for sticking with us so far. That's the presentation finished, but we've got about another 5 to 10 minutes maximum for Q&A. So remember to submit any questions that you might have on in the control panel, and we'll try answering as many as possible. But for Boris, I think there's one already here for you. I'll pass over. Can you explain the reasoning behind your disinflation call for the US and Eurozone, and what the main indicators to look out for in the next couple of months?
Yeah, thanks, George. That's quite a good one, because it gives us actually the ability to talk more about our thought process kind of behind our inflation call. So how we think about it is, in general, we have to think about what is currently driving inflation. And if we look at the US, for example, as a beginner, goods inflation is pretty much already negative. So we have goods disinflation, meaning that the driving force behind inflation right now has to be the services side of things. And meaning specifically, if you look at the CPI components of inflation, the rent and the shelter component. And given that most survey-based indicators are pointing already to lower inflation, and the fact that supply chains have fully normalized, any inflation call for 2023 and beyond this year has to be a call on the demand side, and specifically the shelter component of CPI. And our forecast is really based on the assumption that we'll get a continued fall of the rent component and shelters, because one of the major leading indicators for the rent development and the shelter development are actually home prices, which have already fallen in the US on a year-to-year basis and are falling on the month-to-month basis. And this should put downward pressure on the shelter component within the CPI number. In Europe, I again have to say that it is a bit different, just given their larger sensitivity to the energy sphere. But the same principle can still apply. So without any price pressures in the factory pipeline, which we know of, producer deflation should kind of drag consumer prices back down again. How fast this process will occur is really something we can't answer right now, because it really depends on the extent of the recession in Europe and the tightness of the labor market going forward. But we still do think, and I think this is a consensus view, that the ECB is currently overstating inflation, at least for the year 2024, where they don't see inflation falling below the 2% level. I don't think that this is compatible with the current data that we are getting.
Nice one. Thank you for that, Boris. And another one's come in. I'll take this one. Do you think the UK economy will remain resilient, or should we be buying forward heavily now and taking advantage of a good rate when buying euros? I think I'll answer this in two parts. The first one, the resilience of the UK economy. Obviously, the major story last year was the expectation for the UK economy to experience the worst recession out of all of the major economies. But so far, that resilience has done well for the pound, and obviously, as we've seen this year with the yield advantage, has allowed it to be the best performing currency. Whether or not that continues, we've got to keep an eye really on consumer spending. The UK is a consumer driven economy, so if we're worried at the Bank of England's rapid interest rate rises might drive us into recession, we really need to keep an eye on that consumer spending. And as I mentioned in the presentation, this could be heavily impacted by the this delayed negative impact on the housing market and the mortgage costs. When these fixed rate mortgages come to an end, real disposable incomes are going to be squeezed further, especially if inflation remains as high as it is. So our base case is at least that we may see the stagflationary period, but probably a recession. But how deep that recession is going to be remains to be seen. That's why we're keeping a close eye on the data. But what I will say about the sterling euro exchange rate, as I mentioned, we're approaching 11-month highs, and we are above the average rates on all the long-term average basis on the 1, 2, and 5 year. If you think the 5-year average is 114.60, we're currently 3 cents above that. So from our position, the time is looking quite favourable to be purchasing euros. But of course, it depends on your own business objectives, of course, and what rates you're trying to achieve. Now, there's another one here. Joe, how high could US interest rates rise? Over to you.
Boy, that's a big question. So US interest rates, boy, that tends to, that answer can change almost daily or even by the data. So currently, US interest rates are around 5.1%. Last month, when we got a new forecast from the Fed thought it could raise rates another 2 times, another 2 quarter-point moves if necessary. And if we get that, that would lift rates up to 5.6%. But 5.6%. But don't rule out a move closer to 6% if we continue to see core inflation. And again, core inflation, that's what takes away food and energy prices, which tend to be the most volatile. But if core inflation continues to only inch downward, and if we start to get better news on housing and manufacturing, those are 2 of the key sectors that have been hard hit by the Fed's aggressive rate hikes. If we start to see those sectors showing signs of turning the corner, maybe that could give more traction to the Fed. Maybe that could put more rate hikes on the table for the Fed. And that's why the consensus, well, maybe not the consensus, but a consensus is for rates to rise to about 5.6%, but that there's also a risk, maybe the market's underappreciating right now, that we could see rates above 5.6% if we continue to see pretty resilient numbers. That was the case today with ADP. That was a strong number. It does have the best gauge of predicting how non-farm payrolls might fare come tomorrow, but nonetheless, further signs, really fresh signs of the job market remaining tight. And if the job market's dispensing more paychecks, that's more firepower for the consumer. So we'll have to keep our eyes on the job market. So anywhere between 5.6 and maybe upwards to 6% is the thinking of where US interest rates could rise.
Cheers, Joe. Another one, I think I'll take this one, UK based. Why has the UK stock market performed so poorly this year, but the pound has strengthened? It's a great question, an interesting dynamic that's unfolded this year. First, I'll probably mention that one of the main reasons behind the FTSE underperforming US and European counterparts is likely to do with a lack of technology exposure. Tech stocks only make up 1% of the FTSE 100, meaning it's missed out on that tech, particularly AI boom that we've seen this year. But also those sectors that are overly sensitive to interest rate hikes and recession, like house builder, real estate investment trusts, they've been really hit hard due to the surging UK interest rate expectations that we've seen. But if you think last year, the FTSE actually eked out a marginal gain, whereas the US and European indices fell, and that was partly a result of the pound's depreciation, because it provided such a tailwind for those many in the FTSE that are exporters there. So this year has been very different. The pound has appreciated so much in the wake of those higher yields, as we mentioned, due to the surging rate expectations. And today, in fact, because of these increasing bets on UK rate hikes, gilts are now yielding more than equities for the first time in more than a decade. And that sort of explains why we've seen this sort of disconnect between equities and bonds and the pound there. Finally, I think we've just got time for one more. Boris, where does China fit into the story of inflation and global growth?
Yeah, again, a good one. I think China for us is mainly a story that fits into 2 specific narratives. So the first one that we kind of already mentioned is the story of this global monetary policy divergence, because in recent times, again, inflation is still extremely elevated, especially core inflation remaining sticky. But because of headline inflation falling and some of the economic data being weaker than expected, at least in Europe and in China, central banks starting, I think, from July beyond, will not really be on our autopilot anymore and really ensure markets that they will hike rates at every meeting. It will be more a data-driven meeting by meeting approach. And this has kind of created this weird hierarchy of central banks where we rank the central banks from most hawkish to most dovish. And on the top of this line, as we have heard today from you, George, is the Bank of England, which is expected to raise rates well beyond 6%. But at the bottom of this hierarchy stands the PBOC, the People's Bank of China, which not only cut rates, but is also stimulating its market via these liquidity injections. And this is actually why the yuan has performed so bad against pretty much every G10 currency, the euro, the pound, and the US dollar. So this is kind of one theme that we're watching out for China, at least in the monetary space, to kind of rescue the global economy from this liquidity contraction. And the second one, again, is purely a growth story. We know that the reopening of China has disappointed, especially in the first half of this year. And so with pretty much the global manufacturing sector in recession, Chinese PMIs being below 50, everyone is hoping for the stimulus from the Chinese government to kind of prop up its own economy and in the process help the global economy recover. So this also ties pretty well into the story of asking, because I see one question was about the UK manufacturing sector, which already is in a recession. One base argument for a recovery actually lies upon the opportunity of China being kind of providing more stimulus than is currently priced in. If they're not, it is really looking dire for kind of the manufacturing sector overall, at least in the medium term, while interest rates stay high. So this is definitely something to watch out for, and maybe something, the whole China story, that we can discuss in our next webinar more in depth.
Hey, thanks, Boris. A brilliant answer there. And thanks again to everyone for all the questions. I'm going to respect the time now, so we're slightly over. We're going to end the Q&A there, before making a few final remarks before ending today's session. So firstly, whatever email address you've used to register for this webinar, you'll automatically receive the recording within 24 hours from Currency Convo. So look out for that. And if you want the slides as well from today, then do contact us via the details on this next page here, or reach out to your account manager at Convera. And secondly, please do take some time to complete our exit survey. That provides us with any feedback and any recommendations for what you'd like to hear about in the future. And lastly, remember, this is a monthly webinar series. Therefore, our next one is going to be in early August. And we hope you can join us again to keep on top of the ever-changing macro and market environment. So thanks again to our speakers, Boris and Joe, and thank you to everyone for joining us today. Wishing you all the best and good luck.